In Tesla's earnings reveal, which happened within the last 24 hours, they mentioned two things that the media just didn't pick up on. I don't know how they missed them. Very, very important things to do with cost of Tesla's cars in the future and cost for Tesla to manufacture them in the future. Then they also revealed their strategy, which is very, very interesting. Since Tesla has reported its earnings, its share price, stock price, whatever you want to call it, has tanked sharply. Well, it's a bit of a surprise to me, but I'd say this is a pretty good buying opportunity because Tesla's report is surprisingly positive. I had assumed they would be almost break even and barely make any profit, but that wasn't the case at all, which is very surprising if you consider what has happened, how much Tesla has reduced its prices over the last 3 months. Hello, my friends. Welcome to the channel. Great to see you. Here's the Tesla earnings report, which has just been revealed. Like I said, Tesla's share price is tanked sharply. This is aftermarket trading. I don't know how this will go for the rest of the next 24 hours, for the rest of the week, but right now it looks like the price is just going to keep on going lower. I hold Tesla stock. I don't really care because I see this as a long-term investment. Yes, I've gotten rid of my stock last year in Neo and Xpeng. I reduced my position in BYD as well. So yeah, I kind of feel your feelings here. A lot of people feel like, hey, all my stock price has gone down. If this is your retirement income, I totally understand where you're coming from in that. My suggestion though is long-term investment. Don't worry about day-to-day fluctuations. This news is positive. So what is the basis? Earnings results, 23.3 billion in revenue. 19.3% non-GAAP gross margins. Yes, those numbers are down versus the same quarter last year, but nowhere near as much as what most people thought. What about Tesla's sales? Well, you already know what they were, but let's just go over those quickly again. First 3 months of the year, 440,808 vehicles were produced. 423,000 were delivered. That's a new record for Tesla. Now, considering the fact that this includes the Chinese New Year, it includes the month of February, which is obviously a lot shorter than any other month of the year. It is a very, very good result. The first 3 months of the year are much slower for the automotive industry worldwide than are the last 6 months of the year. Earnings per share. First quarter was 85 cents per share. That's about in line with Wall Street estimates. Revenue, 23.33 billion. That's a slight beat of the 23.2 billion that was expected. However, automotive revenue was 19.96 billion. So you can see that automotive revenue was about 20 billion of the 23.2 billion. 3.2 billion non-automotive revenue. That should, I think, change. The Megapack factory in China, once that's up and running, Tesla will get more non-automotive revenue from that. And then they've got the supercharger network. More revenue will come from that as that builds and increases. And of course, things like Powerwall. So this means that overall revenue actually did grow by 24% year over year to 23.3 billion. And gross margin, while it was down, it wasn't down anywhere near as much as what many people thought it would be. Gross margin was 19.3%. In the first quarter of last year, gross margin was 29.1%. Tesla does have another advantage that probably should be mentioned here, which is that their EVs qualify for the IRA incentives. Obviously, the United States is the most important market worldwide for Tesla. GM is the only other automaker which has a number of car models that qualify for the incentives. And this will give them a big advantage in the automotive market for the rest of the year in the United States. Net income and GAAP earnings. Net income was 2.5 billion. That's around 24% down versus the first 3 months of last year. GAAP earnings were listed at 73 cents. That's down 23% from Q1 2022. Pricing and affordability. Tesla had some comments to make on that. And Simon Alvarez from Teslarati says that a key focus of this year's quarterly results are Tesla's pricing, which got lower in Q1. Of course, prices across the board were slashed by Tesla, which is why I'm surprised to see they still made it 19.3% margins. In the Tesla update letter, Tesla said that while most of the automotive sector is struggling with the economics of their EV programs, that's a really nice way to put it, very generous. Are they struggling? Yeah, they're making a loss. Ford, they said they make a loss of 20,000 US dollars per car. It's claimed that NIO makes a loss of around $17,000 per car. So the fact that Tesla reported a automotive margin of 19% is a staggeringly good result. The company said it's looking to leverage its position as a cost leader, and they highlighted its pricing strategy considers its long-term view per vehicle. Now, it's worth listening to this because you can see here what Tesla's strategy is, and I've been trying to explain this on the channel on a few occasions. Our near-term pricing strategy considers a long-term view on per-vehicle profitability given the lifetime value of a Tesla vehicle through autonomy, supercharging, connectivity, and service. We expect that our product pricing will continue to evolve upwards or downwards, depending on a number of factors. Although we implemented price reductions on many vehicle models across regions in the first quarter, our operating margins reduced at a manageable rate. Remember, Tesla has no debt, or around $2 billion of debt, but they have $22 billion in cash. So they should have around $25 billion in cash right now. They said, we expect ongoing cost reduction of our vehicles, including improved production efficiency at our newest factories and lower logistics costs, and remain focused on operating leverage as we scale. Tesla is factoring in what I've been telling people, which is that the cost of lithium continues to decline. The cost of battery packs has come down this year. That means Tesla's costs have come down. Now, Tesla continues to try and improve their cost situation. They have a team of people that are very, very focused on that area. Clearly, they lead globally in this area. They're saying there, we expect ongoing cost reduction of our vehicles. That means they're going to reduce the price of their EVs further. Probably if you're in Australia, if you're in New Zealand, if you're in Europe, China, I think their EVs will come down in price even more. But once they launch the new Model 3, yes, it's new, it's not just a refresh, and the Model Y in the first quarter of 2024, the prices will probably come back up again. We're going to see new technologies and much improved vehicles, which will lead to massively increased demand for those cars. Therefore, if you want a really cheap Tesla EV, now is probably the best time to get one. The Model Y at $47,000 US dollars base price in the US, $39,500 with the incentive. It's a bargain. Demand will be massive this year as a result of that. Tesla say we remain focused on operating leverage as we scale. Tesla is using its leverage to put pressure on its competition and really try and hurt their efforts to scale up and become electric companies to actually succeed. I think Tesla wants to get rid of some of its rivals. That's my take on this. But I don't see that as a bad thing. I mean, Tesla are putting pressure on other automakers to improve cost efficiencies, to reduce the price of their cars. If they didn't do that, EVs would be significantly more expensive wherever you are right now. So it is a benefit. It is an advantage. Personally, I see Tesla's stock price rising by the end of this year, probably to around about 210 to 225 US dollars. That would be my prediction. My friends, thank you for watching. Let me know your thoughts in the comments. Bye-bye.